On days like today, I think you have to put things in proper perspective. I mean, to me, the most basic, simple way of describing is that central banks aren't going to go back to buying treasuries and selling gold. I think that from here on out, you're going to see more turbulence, more volatility, sharper swings, but nothing's really changed. In fact, I just think you have to not get shaken out. The bull wants to take as few people along for the ride as possible, and you have to keep your perspective. Um, they try and tell us that this was the Chinese dumping like 1 million ounces of gold. Let's just put that in perspective. So, first of all, when we talk about Chinese gold-backed ETFs, in the month of April, they saw more inflows than all of 2024. And that's just in the first 11 days of the month. And when we talk about China dumping gold, first of all, their markets are closed right now until May 5th, which is very peculiar. In fact, this lends itself to making you think of conspiracy and of manipulation and of suppression during Chinese trading hours when their markets are closed. That's a clever trick. To me, that's very suspicious to say the least. And Goldman Sachs' story is very suspicious. And I think the bullion banks were able to exploit the closures in the Chinese markets to smash the price. If you look at a chart, a continuous 24-hour chart, you see it go up every time it hits Chinese trading, it goes up and gets smashed as it comes into New York. Well, with all of the Chinese markets being closed until May 5th, suspicious. Goldman talked about a 31-ton dump, but they didn't make any delineation between the Shanghai Gold Exchange and the Shanghai Futures Exchange. So I did a little digging. The Shanghai Gold Exchange delivers less than 4 tons a day, right? And so, um, in essence, the majority, if not all, of this dumping was done in the futures market. And so I think that that's important here. You're not seeing physical gold being sold off. You're seeing futures being sold, and it's done for effect for sure. Let's talk about what's happening here in the United States. We saw for the May contract in gold, 9,306 contracts stand for delivery. That's the second highest ever for a non-active delivery month. The silver May contract, 14,813 contracts stood for delivery. That's the second highest ever, just behind March's record delivery. And we're beginning to see these short positions that are closing their positions, and you knock it down, and yeah, a good way to close it. But it seems everything's settling for physical delivery. The other side of the short, the long says, great, we'll stand for delivery, please. Who are those longs? We don't really know. But um, to me, this just exemplifies continued demand at the highest level. So I think people need to put things into perspective. It's been quite a run in gold. Silver hasn't begun to blow out from its technical formation. I suspect it will, and probably much more so than what we witnessed in gold. But yeah, I would just simply say that it's going to be bumpy, but nothing has changed, not even a little bit. And with the Fed meetings and all the things that are happening, I think perception. This was a perfect opportunity for, if I had to guess, the Western bullion banks to knock the hell out of the price, say it's the Chinese, even though their markets are closed, and do what they can to close out their short positions or to settle things with metal that they're able to then physically buy on the cheap. So this doesn't bother me at all. Nothing goes straight up. It's certainly violent, but also put it in perspective. A 60 or $70 drop is 2%. So it's not a massive drop. The dollar numbers are higher than most us gold bugs really think about because it hasn't been at these levels for very long. And when you're at 3,000 plus gold, a $300 move, well, it's still 10%, but it's a big one. But when you see 60 or $90 move, which really freaks people out, you're talking under 3%. So um, yeah, you're going to see paper market volatility. That's just the bottom line. You're going to see that the higher the price goes. But I still think gold and silver will climb the wall of worry that everyone is freaking out about on social media right now.
Is the reduction in gold price because Trump and Zelensky signed a minerals deal, which could be the beginning of negotiating the end of the Ukraine war? Is it time to go risk off again?
I mean, all of these things to me are peripheral noise. No, it's not. That doesn't change the structural problems that we have with the monetary system, with our indebtedness, with everything. But and we should hope for peace, certainly. But no, I don't think that changes anything at all. In fact, you could argue that when the war is over, you may see a larger, more concerted effort by the BRICS nations to focus on unity, to focus on trade. We talked about last week. 40 plus countries have applied for the BRICS, Vietnam being the last, and their new payment system, which is now open to non-member nations. They haven't slowed down behind the scenes. They're just not as open about it anymore. And the Russian finance minister is all over the place, Lavrov, talking about this. And so peace is good, but it should not have anything really material to do, in my mind, with the price of gold. Really, it shouldn't. I don't, even if it ended today, I don't see how it materially impacts the United States, the dollar, or any of the problems that are fiscally or monetarily in front of us.
We have a comment here, not a question, but I think you might want to tag on to it from Nitro Burp, who says Fibonacci retracement is normal and healthy. We certainly talked with Gregor Mannarino, the founder of TraderChoice.net, who's a trading coach. He always reminds us that nothing goes up in a straight line forever, and it's healthy in bull markets to see uh, filling in and consolidating because that prepares you to move upward again and shakes out, as you said, the bull is always trying to shake out those who are just in it for a flip or whatever. But any comments from you on the concept that some retracement to Fibonacci levels is normal and healthy in a bull market?
100%. Richard Russell, I'll make it easy because the Fibonacci numbers I don't know off the top of my head, but yes, that is true. Richard Russell always used to say at least a 50% retracement. When you see things move up that high, a 50% retracement is normal. And it is normal and healthy, with somewhat of a gold squeeze. It moved a little too fast. It was exciting. And, we were all thrilled by it and expected it to go straight up forever, but it won't be that easy, not even a little bit. But take a step back again, and you got Treasury Secretary Bessent saying that the bond markets are signaling it's time for the Fed to cut rates. Well, they want to go back to, more easy money and perhaps even quantitative easing. Again, this is very gold friendly. Powell didn't say flat out that he's going to abandon his dual mandate, but he hinted at it. In other words, they're caught. And they know it. We're caught between the ability to fight inflation and to keep rates low enough to stimulate the economy. You're seeing mass layoffs. You're seeing a slowdown in the economy. Um, and so I think, what do you do? I think Trump wants lower rates. He wants a lower dollar, as we've seen. And now you have the Treasury talking about coming in and buying their debt as well, finding ways to buy older maturity debt. Again, this is all monetization. Right now, we saw the negative print on the GDP, right? And so the 2-year Treasury yield is 3.56 right now, but the federal funds overnight rate is 4.33. This is more of what we saw before. This is classic yield curve inversion. This screams of a recession coming. And so, with inflation fears elevated already, May 7th is the next Fed meeting. A lot of this is done by design for optics with the Fed meetings coming up, and everything is okay, don't worry. But they want to lower rates. They want to lower rates not only on the front end of the curve, but even the 10-year and stimulate you're going to see a reignition of inflation. This is all very gold friendly. So, um, I think there are some big players that are caught in the futures market that would love nothing more than to extricate themselves from these positions. So seeing the metals market get knocked down like that and see all of these contracts closing out is not surprising to me. What is surprising is people's reaction, thinking that, well, maybe we should go from risk off to risk on. Absolutely not. I think that this is why emotions very often get the best of us, and it's natural. I get it. It is emotional, but you got to take a step back and ask yourself, what if anything has changed? We're not saving any money on our indebtedness. In fact, we're going deeper and deeper into debt, even with Doge. So the indebtedness is still a problem. The fragility of the economy is still a problem. The geopolitical issues are still a problem. Nothing's changed. But what has changed is there's greater volatility in the market.